Hello, Steve Lentz here with Discover Options. Welcome to this edition of the Market Reports. This is for Friday ending January 13th, getting ready for Monday, January 16th, 2017. Presented material is for educational purposes only and should not be construed as personalized financial advice. Let's get right to it, and then we will get to the details of the reports. Today we'll discuss the S&P 500 Condor Butterfly Timing Report for those of you that trade options and sell premium from a market neutral perspective. And then we have the S&P 500 Directional Likelihood Report for those of you more statistically oriented. By the way, we have a free ebook for those of you interested. If you click on the link, we'll get if you give us the information there, we'll get that to you. Also, we would love it if you were to subscribe by clicking on the button below. Here's the current market condition. Look at this. It's very similar, if not the same, to the condition we had as of last Friday. And you can see it detailed in the highlighted bars there. Bottom line, Thursday was a downswing day with lower highs, lower lows, and then Friday was an upswing day with higher highs and higher lows. That happened 2 Fridays in a row where we were above the 50-day simple moving average, and the stochastic was between 50 and 99 and above the 3-day above its own 3-day simple moving average. So a unique market condition. It's occurred about 90 times in the past, going back to January of 2000, and so kind of a unique situation where it happened 2 Fridays in a row. So let's get to the report for the Butterfly Condor Timing Report. The same negative edge exists in terms of it's minus 4.6%. Now, for those of you new, we're going to dive into the details here, but for those of you veterans, let's just get right to the narrative here. So since January of 2000, there have been over 4,200 daily closes of the SPX. Of those, 64.8% have been favorable for selling premium neutrally. That means that favorable meaning where the actual 21 bar movement was less than the SIBO SKEW adjusted implied movement. Okay, so that is the definition of a favorable bar, where the market moves less than what was being implied by the option prices. Now, also during that time, the current condition occurred 88 times. Of those occurrences, 60.2% of the bars have been similarly favorable for option premium selling. Now, 60.2 is less than the benchmark of 64.8, so that means we have a negative selling edge of minus 4.6%. See that? So statistically, here's the bottom line, folks. Statistically, it's more likely than usual that Friday's bar will end up being unfavorable for market neutral option premium selling. Okay? All right. So that's that report. Let's go to the other one, the market likelihood report. This is very similar to what we saw last week. And what you see are quite a few red numbers, but there's some key blue numbers here. So if the market exceeds Friday's high, you have a lot of red numbers indicating a chance that the market will be less volatile than normal. Over here, if price exceeds the low of Friday, you have some blue bars here, but look at this. You have a couple categories where you have a substantial difference between the benchmark and this occurrence, where we have more a chance of greater market volatility down here, where when the market exceeds the low on Friday, and then the lower bands get hit more often by quite a bit here. See that? So that's kind of what's going on here, in that it's this scenario that's kind of skewing the statistics here, where the market goes below the low of Friday, and then the lower bands get struck quite a bit more often than the benchmark. And I think that's what's kind of skewing this, turning it into a negative edge for for the previous report, and here you see that situation. I mean, that would be quite bearish. If price exceeds the low of Friday, we have a strong chance, or at least there's a greater likelihood than normal, the price will exceed the lower bands, and we'll have more bearish likelihood then in that case over the next 5 and 10 days. Okie dokie. All right, and the same thing kind of exists with the skew adjusted VIX. Few more blue bars in that situation where price exceeds Friday's low. And so that's it for that report. Let's get into the weeds here a little bit. Let's go back to that Condor butterfly timing report. We'll discuss the methodology as well as what's going on right now. Why would you want to look at this report? Well, if the market began to channel back in December of 15, you might have thought it was a good time to jump in, but when you run through our scenarios and our algorithms here, what you'll find is that we had a negative edge at that particular point in time, and that meant that there was a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices, kind of like what we have now. In that particular case, the market took off to the downside by a great degree, and was that negative edge predictive? Well, not necessarily. That's just kind of a nice cherry-picked case showing you that it would have been nice to have had a heads up that moving into the future, there was a greater likelihood than normal that price was going to be more volatile than implied. Okay, so here's the current condition as we went through, and on this Condor butterfly timing report, here's the question on the table. Is this current condition a good one for selling premium through range trading butters and condors? Is it a good one? Well, how do we answer that? Here's what we do. We observe how much the market actually moves from the close. We call that actual volatility. Then we observe the market move that's predicted. We call that implied volatility, and then we compare the two in retrospect, in hindsight, and determine if a bar was favorable or unfavorable for selling premium through range trading. Let me show you how we do this, just an example. Okay, let's look at the actual move. The actual move. So we take a close, we go forward 21 bars in the future, and just ask ourselves how far did the market, or what's the most that the market moved over the course of that time? What's the farthest distance away it moved? And it moved that far. It moved down in this particular case quite a bit. It moved down about 50 points. Turns out to be about 2.4%, and we can actually graph that move down below that you see. Now here's the question. What market move was being implied? We know it moved 2.4%. What were the option prices saying the market was going to move? And when we dial this up, we look at the skew adjusted 21-day VIX. It was implying a move of 4.4%. 4.4%. That turns out to be greater than what the market actually did. Do you see that? And in those cases, we're going to label those bars favorable, where the market is implying a move greater than what actually came about. So we're going to paint these bars blue wherever you have this blue line above the red there. Now, we can't do it in the immediate 21 bars, but going back 21 bars, moving backward in the past, we would color all these bars blue. Okay, such that the favorable bars are blue, and then the unfavorable bars are red. Now, the unfavorable bars had ensuing moves that were greater than what was being implied. You can see down here I have implied and the actual graphed here in blue and red. So these red bars they turn out to be unfavorable for selling premium neutrally because the market moved a lot in the 21 days ensuing from there. So here's what we do. We ask ourselves historically, what percentage of these bars are favorable and unfavorable? Then, once we have that, we look at the bars that just match our current condition, all 88 or 90 of them. And we look at the percentage of those that were favorable. There might be a big difference there. In this case, okay, going back in the SPX, going back to Jan of 2000, 64.8% of the bars turned out to be favorable. Okay, and then 35.2% turned out to have been unfavorable. Now, what we're going to do now is look at our current condition, the one I just showed you, where we have about 90 incidences of those, and we're going to see what percentage of those going back turned out to be favorable and unfavorable. 60.2% were unfavorable, or excuse me, favorable. 39.8% were unfavorable. Now, this 60.2 is lower than the benchmark, right? So if that's the case, time out, going the other way, we have a negative edge of 4.6%, meaning that there is a higher than usual likelihood that the market will be more volatile than what is implied by the option prices. Okay, so that's the report for the Condor folks. Before we move on, I want to make sure you understand we have a great options mentoring program here at Discover Options. We will team you up with 3 different mentors if you take our equity track or futures track, and these guys will get you up and going and get you from an intermediate level up to an advanced, maybe even a money manager level in as fast of time as possible through the use of our progressive way of learning, the tools we give you, and the homework we give you as well. So call us up, take a look at this on the website. We'd love to custom make a curriculum just for you that makes sense. Let's get to the market likelihood report, okay? We have our current market condition. Here's the question on the table. Since Jan of 2000, how often has this same condition occurred? Roughly 90. And what did the market do in terms of direction and volatility? Did it go up, down, wobble around? We want to go back to those others and just see what happened. Those other 90 examples, and just see what happened in that case. Well, we have to have a way of measuring the way price behaved. So here's what we do. We measure price in that behavior through the use of historical distribution of price. We look at price distribution historically, and then we look at it after those 90 specific times that matched our current condition. If there's a big difference, we can conclude that there might be an edge. Okay? So here's how we determine historical distribution of price. We measure this by observing how often price touches one standard deviation volatility bands that are placed from each bar's closing price. So we use 3 of them, a 5, 10, and 15-day band, measured both above and below the current price. Okay, we use a 20-day historical volatility input, calling that statistical volatility, and these are log normally distributed. So here's just an example real quick. Okay, we have a close. We have an upper band. These are 10-day bars. These are set 10 days out, one standard deviation above and below closing price. Now here's the question. Did price go up and hit the upper band? Did it hit the lower band, or did it fail to? Let's take a look. In this case, it hit the upper band, and that's what we put here. Is we note for that close, price hit the upper band. Now let's take a look at this close right here. The 10-day band to the upside, 10-day band to the downside. Did price hit the upper band, the lower band, or wobble in the middle? Let's take a look. Sure enough, it wobbled in the middle. It tried to hit this lower band, failed to, so it hit neither of them. So what we do is, to determine distribution from every close, we record whether price struck the upper or the lower 5, 10, and 15-day bands. And we record those statistics. And here are the statistics through Friday the 13th. Price hit the upper band 29% of the time, 23 on the 10. The 15-day band got hit about 23% of the time. On the lower bands, the lower 5-day band was hit about 29, a little more than 29%. The 10-day band, a little more than 29. The lower 15-day band, 32%. So that makes sense, doesn't it? That price would strike those bands that often. and then we measured, then there were 4,262 incidences that we measured this going back. So now let's take a look at the distribution after a specific market condition develops. We have our market condition I just showed you, and we're going to look at not only the distribution as of the close, but also what happens if price goes above the high of that previous day. What if it goes below the low of the previous day? That way we'll have a kind of a good idea going into Monday's open what the statistics are, whether it goes up above the Friday's high or below the low of Friday. So here's the benchmark at the close statistics. 90 occurrences. Okay. Price struck the upper 5-day band 14.4% of the time, much less than the benchmark of 29.2. Do you see that? It struck the upper 10-day band less often, 15-day band less often. It struck the lower 5-day band a little bit more often than benchmark. And then it struck the 10 and 15-day bands pretty much a wash, very, very similar. All right. So we see a bit slightly less market volatility implied here by the that one statistic. Now, if price goes below the high from Friday, what's the distribution in that particular case? Again, 5 of the 6 have lower values than the benchmark. See that? Just one over here, it's about the same. And then if price goes below the below the low, this is where we see higher likelihood, except for this one here where it's only at 0.95. The other 5 out of the 6 you show higher numbers, particularly over here on the 5 and 10-day band. Okay, so a little bit of a mixed bag, but some of these numbers are significantly different than the benchmark. I like to also adjust the bands so that they reflect a skew adjusted VIX. And here you have some statistics for this as well. Kind of the same though. If price goes above the high, then the upper bands are really getting struck less often, quite a bit. If they go below the low from Friday, you have 3 bands that are getting struck more often on the lower side. So I think that gives you a little bit of an idea of what to expect. And away we go. Now here's the volatility down here. Just for those of you that need that going into some of your decisions to be made. Statistical volatility is very low. It's about as, getting down near the lower, almost setting a record low. Okay, the VIX adjusted bullish volatility is at 9.4. The downside volatility at 13. Again, these are very, very low. And I'll tell you what, folks, these are so low that the yield on some of our strategies is really now to a point where it's below our thresholds, and so we really wouldn't, I just don't feel comfortable throwing a trade out because the yields are just so very, very small. I'm going to forego that this week. This is the first time I've ever done that, but that's just what's going on. And because our spreads are set up in a certain defined way and we demand a certain yield, which is available almost all the time, but right now, as we speak here going into Monday, they're just not there. So for the way we like to set up our butters and condors and bull put spreads, just not quite there yet. We need a little bit more juice in the options to go after it. Thanks for joining us today. I'm Steve Lentz with Discover Options. We'll see you same time next week, same channel, same time. Take care. Bye-bye.